Hello and welcome to the Kingsview Investment Strategies Q1 Market Update and Portfolio Review. My name is Scott Martin, Chief Investment Officer and Portfolio Manager at Kingsview Investment Strategies. Joining me today, familiar face, Paul Nolte, Senior Vice President and Portfolio Manager as well at Kingsview Investment Strategies. Paul, as always, your busy schedule permits time to join us. Thank you very much. Hope you had a good holiday. Gosh, how about digging right in today to effectively what was a tumultuous Q4, let's say, to say the least, but talking about the portfolios, Paul, that we run at Kingsview Investment Strategies, some of the changes we made, some of the data that we've been paying attention to over the last several weeks and months with respect to how the asset classes were positioned in your portfolios at home there. Let's dive right into maybe some of the soup du jour, which is the market volatility, both, I guess, Paul, on the standpoint of how the markets finished the year and kind of how things have started out the year, given that today is January 9th as we record this. The S&P has rallied quite a bit so far this year. How are things shaking out in your world?
In our world, we're very happy to see the end of 2018. The fourth quarter was probably one of the 20 worst quarters in the history of the market.
Yikes.
Well, the good news is, as long as we're not in a recession, and I don't think we are today, nor are we projecting one, the returns going forward are actually pretty good. Low, or I should say mid-single digits to maybe double-digit types of returns. So coming off of a fourth quarter, and that's where investors really priced in a recession. The anticipation was the Fed was going to continue to raise rates, they were going to cut their balance sheet, and they were going to take it all the way to the end, and we were going to wind up in a recession sometime this year. So that's what was getting discounted in the fourth quarter, and why we saw the spreads between high yield and Treasury blow out, all the risk assets down a lot. Everybody ran to the security of Treasuries, utilities, et cetera. And so now we're seeing that reverse a little bit here in the first weeks of the year. And I think investors have kind of jumped ahead of the game right now. And I don't think things are as bad as the investors think it is. I think the economy is still doing okay. But we still have to pay attention to the Fed, because the Fed is really central to the discussion around the financial markets going forward.
Yeah, and I like what you mentioned about some of the safe haven or risk-off trades or positioning that was made by investors, including ourselves too, as money managers through the Kingsview Investment Strategies, a suite of portfolios. And that, you know, looking at some of the data points, Paul, that we follow very religiously, which is, you know, jobs reports, GDP, consumer confidence, business confidence, consumer spending numbers, you know, all those things that are out there on really almost a daily basis these days. You know, following those data points over the last, say, 6 to 8 weeks rather, in the last couple months, I think helped us kind of get prepared for what was a rough market in Q4. So maybe we could talk a little bit about maybe a recap of some of those data points over the last, say, 6 weeks that the market, I think, reasonably was reacting to with respect to maybe even hints of a slowdown, Fed changes, things like that.
Yeah, when you talk about all the confidence numbers and you take a look at some of the what we would call soft data, which is a lot of the survey numbers, those had turned down a little bit about mid-year. So they were very high, near all-time highs, peak levels. They've softened up during the following quarters. Housing has been weak for the last 6, 7 months, 8 months or so. Hard data point. The industrial production numbers have come down a little bit. We saw a huge inventory build in the first half of the year, I think, as a lot of companies were trying to get ahead of the tariffs and import as much as they could so they can set up supply chains to work their way around the tariffs. That came off, and so those numbers softened up. We saw also within the markets a shift from value to growth, or I'm sorry, the other way around, from growth to value, starting about June of that year, of last year as well. Again, coinciding with all those numbers kind of softening. So now, as we're into the new year, we've kind of gone back to growth for a little while, but we think it's going to be temporary. I think those things are in place where we're not going to be running as hot as we were first half of the year. We'll be a little bit softer. We're still looking at 2.5% GDP growth, which is very good. But I think you're going to see value now take over the helm for a while.
And the growth to value move that we made at the KISS side of things was really helpful, I believe, in mitigating some of that volatility that a lot of the major markets saw because of the fact that that growth value spread got so wide over the course of the market's rally over the last several years that adding to the value positions that we'd already had vis-a-vis some opportunistic positioning in the KISS portfolios, I think allowed us to kind of stand out a little bit amidst that market volatility. one other thing you mentioned I thought was interesting was the tariffs. I mean, constantly on our minds, certainly constantly in the news. How do you think the tariffs impact earnings going forward as we start to head into a really pivotal, I believe, Q1 earnings season here with respect to how companies are going to comment on some of the pressure that we're seeing from the trade wars?
We've already heard from a couple companies, FedEx, and they're the mover of all the goods, and they've noticed a little bit of weakness. Apple came out and said, hey, by the way, China is really hurting us. The rest of our business is good, but China is a sore spot. Micron was another one. And we've also heard from some in the administration talking about the Apple comments about missing or cutting their revenue numbers based on China. And he said, if you've got companies that are going to be based in China or going to be doing business with China, you're going to see those numbers come down a little bit. And the market's got a little concerned around that when Apple released their numbers. So I think we can see first quarter not soft, but certainly compared to the very good first quarter last year, it's going to pale in comparison. But the numbers should still be halfway decent. But again, they're going to come off, and the tariffs are going to be a big reason for that.
And I wonder if that's one of those things. I mean, the markets are great in the sense of they're very psychological, almost at times more psychological than they are fundamental, right? So I wonder if this is one of those quarters, Paul, where it's almost already baked in the cake, or at least the market's expecting really bad comments from your favorite S&P 500 companies as it relates to tariffs. And then maybe if those comments aren't as bad, or maybe the outlooks aren't as bad, maybe the market says, okay, well, we're going to get past that. I think the one risk that's out there, though, is the further that this drags on with President Xi, the China president, with respect to how long we can't get a deal done or get some movement on at least progress, is probably something that's going to weigh on the markets, in my opinion, in our opinion, because of the fact that it's just dragging out and impacting more business as this drags on. One thing we've also talked about today is this looming or not looming prospect of a recession. Do you want to speak to a very key recession risk ratio that we have at King's Investment Strategies here that basically affects how we position our assets in these portfolios that we offer here? Talk about the recession risk ratio and what that looks like, please.
Absolutely. When we looked last year, and again, that was one of the indicators that we saw was coming down toward a recession level. Never quite got there, but was certainly getting close. And it's one of those where it's kind of an off-on switch. The difference between one number and another is not that meaningful until it crosses the zero line. When it crosses the zero line, then we really start to sit up and pay attention. We got close to that zero line, never really crossed it, and we're actually getting further away from it now. So it looks as though, again, some of the recession fears might be overblown. That said, we're still seeing some financial pressures. You're seeing a lot of stress in the financial markets. You're still seeing some of the spreads blow out, as we talked about before, with high yield, et cetera. Those tend to lead to or toward a recession, but that usually is an 18-month to almost 2-year lead. So we're looking at the best middle of next year. Financial markets don't look that far in advance.
Yep.
And I think that's what investors are trying to do, seeing that data and then trying to leapfrog it and get in front of it, saying we have a recession on the horizon. When Powell backed away from his comments, all bets were off, and that's when we really started to see the markets rally.
I really like that notion because it's almost like you're worrying about things too far in the future, at which point you lose sight of the short term. And so much can change in that short term that does eventually affect that long term that you were worried about as an investor. So therefore, you've got to keep those things in perspective. As a kind of anecdote to what you touched on there, I mean, you're right, behavior of risk assets besides yield spreads was, crude crashing right over the course of the fourth quarter. Obviously, gold rallying too, which was like that risk-off trade, things that we've kind of tried to take advantage of in the KISS portfolio positioning. Things that have happened in those portfolios have really been, or at least in those asset classes, risk-on or risk-off, have really helped, I believe, our portfolios kind of shine here. One other thing, Paul, when we look at the economic data, you look at the recent jobs report, 312,000 jobs added for the month of December. Obviously, revisions to the prior couple months before December, which is a great sign. Wage growth now, at a multi-year high as far as growth that we've seen there. Average work week is up and so forth. Let's maybe talk about how the data goes forward with respect to GDP and jobs numbers and what we're looking to see out of those numbers as it may affect portfolio positioning this year.
Well, as we talked about, GDP will back off some to probably that 2.5% range. The jobs actually have been strong all along. We've now 100 months of job gains. And really the last couple of years, we've been averaging between 175 and 200,000 jobs pretty consistently on a year-over-year basis. And when you look at it, we only need about 130 to 150,000 jobs to maintain the jobless rate. So we've been running much above that, and that's why we're starting to see people come off the sidelines and enter the workforce that haven't been in the workforce before. So the job market is very, very strong. The only caution that I have is the job market tends to be one of the lagging indicators. So it will be one of the last ones to turn. So we're very cognizant of that and watching these job numbers to make sure that they continue to be strong, again, pushing out that likelihood of a recession. If we look at the weekly jobless data reports, the new
claims, yes.
The new claims, those are still at 40-year lows.
Amazing.
Or very close to it. So we don't really see the jobs picture changing anytime soon. So again, that gives us comfort in the fact that we still see a growing economy. Again, maybe a little bit slower, but still growing. And that's what we're going to need to see to continue to see good earnings numbers and potentially higher stock prices over the course of the year.
Last thing, interest rates. Way down from October. I mean, my goodness, what a downdraft, especially the 10-year, maybe if you want to call that the barometer rate or benchmark rate, as far as, 3.25, almost all the way down to 2.6 recently, now bumping up a bit because of the rally in equities. What do you think about rates going forward this year, Paul? Not so much maybe even based on what the Fed is going to do, because it's anybody's guess. It looks like the markets or Fed Fund Futures is probably looking more like they're not going to do anything now, my goodness. Right. But rates in general, as far as, how the curve looks and how interest rates may behave vis-a-vis or outside of the Fed when it comes to the 10-year note.
Well, when you take a look at the yield curve, it's flat. It's been pretty flat and consistently so for the last 4 or 5 months.
Does that concern you?
It doesn't yet. And if we need to, again, like our recession indicator, it needs to go negative. And then we need to see the yield curve really start to steepen. And that will tell us that we're in that recession. The fact that it goes negative is a warning sign. But then when it steepens out again...
So you're worried about a steepening curve.
A steepening curve is really what I'm most concerned about, that will tell me that things have changed. Right now, everybody's looking at it as a potential for a recession. When we look at the inflation numbers, both in a lot of the industry data, the CPI, PPI, the ISM
GDP deflator
data,
too, absolutely.
The ISM,
Fed dot plot.
Everything else is low.
Yep.
So there really isn't the inflationary pressures. You're only seeing it in wage growth, which for the worker is great because the inflation numbers are low and their wages are growing at about 3.5%, toward the upper end of the historical range, 2 to 4%. So we're getting up to that speed limit. There's room yet to go. So inflation is not an issue, and that's really where the Fed is going to have it. It's really going to be caught between a rock and a hard place, because the inflation data does not warrant them to raise rates. The only thing it does is employment, and a lot of people are going to look at that and say, well, that's a good thing. We're employing a lot of people. Lay off.
Yeah,
and that's essentially what the message has been, and I think Jay Powell has got it now.
That's good. Steepening curve as a worry is kind of an interesting take, and I like that because the main comments are, oh my gosh, the curve's inverting, it's flat, that's the worry. No, steepening curve is actually something to keep an eye on if you're playing at home because of the facts of the information you just mentioned there. So, great, Paul. Always influential as usual, very interesting stuff. Thanks for taking some time out of your day to join us and give us some insight. And thank you for joining us today, too. If you have any questions about anything we said, comments, questions, or any other things you'd like to talk about with us more in depth, please reach out to your investment advisor at Kingsview Asset Management. Thank you again.